Hey, this is Paul, Stone Barn Portfolios. Glad you could be with us today. Hope the season's treating you right. We're coming up on Thanksgiving here in about a week or so, and it's always a nice time of year for us around here. Hey, I read an article over the weekend about losing less in your portfolio and whether that's a successful philosophical approach. It was in Seeking Alpha, one of the public bulletin boards that does a lot of investing information and articles. I'm going to post a link to the article, right under this video, so that if you want to look at it, you can. But it prompted a thought for me because Stone Barn has long embraced low volatility investing, and because we think that it works and it works very well. We've got a couple of interesting wrinkles in our approach to it that we think make it even more effective. And so I asked my buddy Don down in Athens, Georgia, if he would think about this and take a look at it and put together some thoughts. And so we're going to connect with him in just a second and talk about low volatility investing and why we think that it's a great way to invest. So hang around just after this. All right, good morning, Don. Monday morning. Hope the weekend was good for you. We're busy up here. But as you know, I read an article over the weekend that was about low volatility, and I'm gonna show that in a bit and put the link to the article of Seeking Alpha down here in the box under the video. But you and I started talking about it, and you said, you know what, let me put together a slideshow here and kind of illustrate some of the things that you and I have come to understand over the years about the importance of using low volatility investing in a portfolio. It's not the be all and end all. In fact, we think that you need to couple it with other things, but it's a huge boost to a portfolio. I'm going to share my screen and we'll get into this. All right. This is the article that I'm talking about, winning by losing less. And the question that I'm asking today is, does losing less always mean winning more? This is the article that kind of got us talking about this, because you and I have been living here with charts like this for the last several years.
Right.
And so I'm gonna try to walk us through this and ask you to comment on these. These are the slides that you put together for us. And here we are asking, does losing less mean winning more? We're going to see if we can answer that question here today. All right.
Sure.
All right. This is the first slide here. What are we looking at?
First off, the black line is just the basic S&P 500. It's based from starting in 2000. We actually went through a couple of bear markets, but the red line is the least volatile of the S&P 500, the least volatile top 100 stocks, and I think they're done upgraded quarterly.
Quarterly, I believe you're right.
And it's very appealing to the eye to see that, while, and go back to the 2000 time frame, you can see that was about a 50-60% takedown, and the low vol index just kind of wobbles slightly sideways to maybe a little higher bias. And so in Georgia down here, we say, we're just leaving from the low points at a higher level.
Yeah, right.
And we didn't have to dig out of too big a hole. And I think it's fairly prevalent to see, as you move forward to 08, it did the same type action. And if you go back and study just the bear markets or just the bull markets, it's in the bullish regimes, it's, the low vol index, total return index is pretty much an average performer as compared to the S&P 500, which is sort of the benchmark. but it really does a home run job, in the tough markets. And
Right.
so,
Yeah, the couple of things that I notice here, that red line, as you mentioned, is the low volatility index, total return index that S&P does. Um, from 2000 to 2019, it's got about an 11% annualized return versus the S&P cash index, which has just about a 3.5% return. If we use the total return for the market, it'd be about maybe 5%.
yeah,
Um, but still some pretty significant drawdown. This this takedown from here to here was 40%. Still pretty hard to sit through. Better than the S&P, and compared with the return, worth it. But it really does a nice job. And like you mentioned, we're going to take a look at how this does during bear and bull markets. Let's take a look here. Now here we are with two bearish regimes. The pink areas are what we term bear regimes. We use a very simple metric to calculate that. It's a moving average type of thing. But these pink areas are what we would call bear markets. The white ones are bull markets. The two that everybody's going to recognize most are these ones from 2000 to 2003, which were the tech bubble burst, and you can see that what happened in the S&P 500. And then over here, the financial crisis in late 2007, starting in late 2007 through March of 2009. This is the financial crisis bear market. Two protracted bear markets, multi-year and multi-decile. The S&P down almost 50% here and down almost 60% at its worst there. And so these are bearish regimes. And what we're focusing on here is what the S&P low volatility index did. Oh, I'm sorry. This is actually our low volatility basket.
yeah, I was going to correct you.
Yeah. Well, good. I'm glad I caught it before you had to. During those bear markets, our stock selection, low volatility stock selection, you can see what it did. We'll compare this to the low volatility index in a minute.
Yes.
Don, there's a flat line here. What does that tell you?
Well, probably the most unique thing you've ever developed, in my opinion, is in the low volatility, we have what we call maximum acceptable volatility, MAV. So it doesn't matter, each individual stock that we own, if the volatility is too great, it doesn't matter if it's going up or down, because this is a low vol component.
Right.
And it is totally unique. I've never seen anything like it. I'm not even sure I understand, if you really know the truth, but ultimately it works. And it's been something that, the negative part of it is it's probably, as you can see, not great at getting back in, because it makes the volatility come back to acceptable levels before it participates. But you sure save yourself some pain and a few pennies along the way by having it as one component of our portfolio mix.
Right. There's a few periods in here where that happens. Back here in 2002, there's a flat line there that you see, and up here, of course, here's a little area here. It's not quite flat, and I'll explain that in a minute here.
Yeah.
But you can see that there are a few times where there is just nothing in the S&P 500 basket of stocks that at that given moment has volatility that we're willing to take. Now, you notice over here, as you pointed out, it was late in 2000 before this particular strategy began investing again. And you'd say, well, hey, you really should have caught it down here. But that spike down was followed by a spike up. Well, that spike up, that's volatility.
That's right.
Now, we shouldn't necessarily punish this, punish the model for upward volatility, but it, we've tested this every way from Sunday, and separating out the upward volatility and the downward volatility, very, very difficult to do. We handle this late re-entry here a different way, and that's by pairing this low vol model with a momentum model. The momentum model that we used actually began investing back in here. So you put the two models together, and you end up with a workable portfolio strategy. But like you mentioned, the point of this particular approach is to lower volatility and to avoid it where necessary. Right in here, the way it does it, there's nothing tactical about this. There's nothing that says, hey, we're market timing. The only thing that controls in here how many positions we have, whether it's 0 or some other number, is how many stocks are available with volatility that meets that minimum acceptable volatility parameter. So in here, you can see that there's some, at the time that this market is going down here, this thing's just bobbling around, going nowhere. And at that particular point in time, we probably only owned 1 or 2 positions instead of more. In here, we didn't own any positions. And then we began to reinvest here as more stocks became less volatile and offered us opportunities. That's the way this thing works. It's a little bit different than anything I've ever seen. We developed this over about a 3-year period, and are really pleased with it. It's an important component of the portfolios that we use. Where you and I both invest, a major amount of our own personal.
Paul, sort of as an aside and an update, just a day or two ago when we decided what we were going to talk about, is that I looked at the S&P 500, and right at that time there were only like 110 stocks that met our
criteria,
volatility characteristics that would even qualify to be a part of our portfolio. So it is all about volatility. It's not about growth. It's not about value and all these other ways that people try to mix it up. It's about the volatility of the index that we're trying to pick stocks out of.
That's exactly right. That's a very important point. We just took a look at the volatility of our model during 2 bear periods. We're back to looking at the low volatility index here, and this is during the bull market that we've had since 2009. Starting in the middle of 2009, we've had this tremendous, really bullish trend with a couple of shakeouts. Here this was about a 15% drawdown here. This was about a 12% drawdown there. So we've had these shakeouts in 2010, 2011, but for the most part, this black line, the S&P 500, has really been, in an upward surge. So the question is, well, how did the low vol stocks do in the meantime? Well, let's just take a look at this. We had a 16% annualized return for the low vol index, with a 13% max drawdown versus a 14% annualized return for the S&P cash index and a 20% max drawdown. So it holds its own and does quite well. Again, if we were to use the total return S&P here, these two things would match up very, very closely. So during bull markets, you're really not giving anything away by using low volatility stocks. And when you look at the index in the bear markets, that's really when it really adds its value, and it's important to have that component in there. We started out this talk by asking the question, does losing less always mean winning more? The answer to that is no, it doesn't always mean winning more. And the reason is, for instance, let me give you an example. You could put your investment into a CD that's paying you 2.5% annualized return, and you'll you won't lose because you'll have a guaranteed return, but you won't lose anything over the maturity length of that CD. But it doesn't mean that you'll win more, because for the most part, your dollars are sitting on the sideline. An important part of winning is having your dollars in play and working for you when they should be. And we think that, no, if you don't use Stone Barn, if you don't follow Stone Barn strategies, if you just, if you just decide that you don't like them, if you're more of a buy and hold investor, we say, hey, God bless you, but you need to have something like this low volatility fund in there. This fund has been around for 30, or this index has been around, it goes back 30 or 40 years, but there hasn't been an investable vehicle out there like an ETF or a mutual fund. I think maybe the earliest one showed up about 10 years ago. But you need to have something like this in your portfolio if you can get to it. If you're a 401k investor, it might not be available unless you've got a brokerage option in your 401k. But think about putting something like this in there, and let's just keep looking at some comparisons here. Going back to 2000 again. Now what we're doing is we're looking at the Stone Barn low volatility approach. This red line is the way that we trade the S&P 500 by picking 5 low volatility stocks each month. And we pointed out some of the things that, this little flat line in here, here's the tech bubble bursting, here's the financial crisis. You'll recognize these flat lines from that. But you can see how concentrating and picking only 5 rather than 100 low volatility stocks, and having a filter on there that says only use those with the best low volatility, and don't take some stocks when they are more volatile than you're willing to accept. These are the kinds of things that we can add to a portfolio mix. Anything you want to say about this slide, Don?
Looks pretty good to me from down here in Georgia. That's the reason we own this.
Yeah, the stats on here, about a 13% annualized return with a 14% max DD versus the S&P with a 4% and a 56%, 57% max DD. The comparisons are
some of the verbiage that it's the low vol is a risk anomaly and not a return anomaly.
Yeah.
Over long periods of time, it has very good return characteristics. Also, it just does, and we added our little maximum allowable volatility component to it. It does a great job in both areas, as far as I'm concerned.
Yeah, it really does, and it's I think an important point to make, that this is as you just said, this is not a return anomaly. This is a risk anomaly. You used your Georgian colloquialism a moment ago that said, you start digging a hole, and what the strategy is it's smart enough to know to stop digging. And so that when it comes time to climb out of the hole, you don't have as far to climb out. And that works to your advantage, both in the long term and the short term. So think about a low volatility approach. We not only do this with the S&P, we do this with the NDX too. Same kind of thing. Now you'll see that there at other times, certain times, the S&P does better than the NDX. The NDX is the blue line. Same approach, same strategy applied to both index families, and you'll see that sometimes it's better to own the NASDAQ low vol stocks, and sometimes it's better to own the S&P 500 low vol stocks. Well, when is it better and when is it worse? Well, look at these here. You get pretty comparable year after year, long-term annualized growth rates. And that little 1% difference here you can see it does make a difference in the long term over years, but about the same drawdown, almost indistinguishable drawdown. So, the drawdown risk is equivalent. So how do you choose on which strategy to employ at any given time? We would say, well, why choose? Why don't you just use both of them together? There's no tactical thing here. As you'll see that the NASDAQ does the same thing here. It actually stays out longer. The NASDAQ was more volatile. This was the tech bursting. The NASDAQ stocks were more volatile, and there were none available here. There were none available here that met our minimum acceptable volatility parameter. And so we sat in cash during that period. So what do? Well, we suggest rather than select one of those two, why don't you put them together? Put them together, and you actually do better than either one by itself. This is 50% of the S&P low volatility strategy and 50% of the NDX low volatility strategy. You'll recognize those numbers from the previous slide. Put them together, and this is what you're looking at. You get about the better of the two performances with less drawdown overall. This is a neat way to go, and you can build this portfolio from our strategy pages and our allocation pages. We'll tell you how to do this. This is essentially owning 5 S&P stocks and 5 NASDAQ 100 stocks at any given time, up to that many. Sometimes you don't own any, but there you go. That's a pretty good looking line. What do you think?
That's the reason I got my pennies stuck right.
Me too. Yeah.
Paul, a couple more quick points. Because of the non-correlation or low correlation to the S&P 500, very few money managers and mutual fund people can afford to commit the way we do, right, because they're actually wanting to be like that black line rather than not being like it. And so it's something that in terms of the verbiage that's they're not very correlated, they're not very benchmarked to the indexes, and so therefore it has some days that the market is up and the low vol will lag it some.
Yeah.
There's days that I just looked a few minutes ago that the indexes were down 20 or 30 basis points, and our portfolio was up 10 or 15. So it doesn't link up like everybody else wants it to. It has some weird stuff that goes on, but volatility, low volatility over long periods of time will outperform high volatility, or the good news, the fast track things that are up 14% and did this and did that.
Yep.
All the same way, and our volatility control keeps us out of those kind of stocks.
That's exactly right, and that's why we say whether you follow our approach or not, there are products out there that are pinned to the low volatility index that you ought to consider if you're not going to try to kind of add the kind of alpha to your portfolio that we're trying to do. So if we go back to our question, does losing less mean winning more? I hope that we answered this question that yes, it does. But you've got to stay invested and you've got to manage your volatility. That's the caveat. Being invested and managing your volatility is important. But if you can do those two things, you will always win more because you're losing less. It's a critical point of portfolio philosophy and portfolio structure and money management that we think that the world doesn't pay enough attention to. But for us, it makes a huge difference in the way we manage our own money. What do you think, Don?
I think I'm gonna have a drink to that this afternoon. Late.
To- toast, toast to low volatility. Yeah, yeah. I got my coffee cup here. Yeah, yeah. Good stuff. Hey, those slides were great. Thanks for putting those together. They really tell a good story, I think.
It's I think it's one of the more unique things that we've evolved into, and certainly your contribution about the volatility control is unreal. And as we have discussed a little bit recently, there will have some times that volatility is really just more than you can take,
Hmm. Hmm.
and we have a solution. In fact, we have a way to actually exploit it in some ways.
Hmm.
That's another story for
That's
another day.
another story for
We
another
got to
day.
move on, though.
Yeah, yeah. We can't just do an hour's worth here. I'm already getting bored with me. So, all righty. Hey, good stuff.
Yes, sir.
Appreciate it. Well, and we'll talk soon. All righty.